Welcome to another episode of the CRE Exchange. I'm Cole Perry, your host and Associate Director of Research at Altus Group, here to share the latest news and trends shaping the U.S. commercial real estate market. It's a busy stretch for the research team, so I'm flying solo on this one, but don't worry, Omar will be back on the next episode. Today, I'll be walking through some highlights from our Q2 2025 Investments and Transactions Quarterly Report. We'll cover deal volume, pricing trends, and the biggest takeaways and surprises from the quarter's CRE sales activity. Before diving right into the numbers, let me give you a quick refresher on what the report tracks and why it matters. The Investment and Transactions Quarterly is produced by Altus Group's U.S. research team and provides a comprehensive look at U.S. commercial real estate investment sales. Drawing on more than 4 million transactions dating back to 2000, the report highlights high-level investment and transaction trends and adds context to the broader CRE market. The data reflects non-distressed commercial property sales across multifamily, industrial, office, retail, hospitality, and commercial general mixed use. We track volume, pricing, and pacing at the national level, with additional insights down to the metropolitan statistical area, or MSA. So let's jump into the headline figures. So the first is going to be investment volume. Now, aggregate transaction volume reached $115 billion in the second quarter of 2025. That was a 3.8% increase from the same quarter in 2024. Gains were driven primarily by multifamily, up 39.5%, and office, up 11.8%, which together made up about 44% of total deal flow, or just under half. On the property count side, 41,463 assets changed hands through the second quarter of 2025, down 7.4% from last year. But the decline was uneven. Multifamily property counts fell 9.2% and office slipped 5.2%. Compared with the prior quarter, the average number of daily transactions rose across all sectors, though activity still sits at or below the 2015 to 2019 pre-pandemic average. So far in 2025, the number and dollar value of single property deals are closely tracking with 2014 and only slightly lagging 2024. Finally, performance varied by geography. Most major coastal metros outpaced national trends in terms of count and dollar, while New York and San Francisco were notable laggards, underperforming by as much as 10% relative to the national change. Now, pricing, we can look at this quarterly, annually, and then some MSA level statistics. But in Q2 2025, the median price per square foot for single property transactions rose 5% from the prior quarter. Gains were broad-based across sectors, with the exception of general commercial, which slipped 2.2%. Retail saw the largest increase at 10%. Looking at subsectors, 13 of 15 posted quarterly gains. These standouts were automotive, with price gains of 25.4%, limited service hotels with gain of 17.2%, and medical office with a gain of 15.1%. Now, annually, the median price per square foot climbed 13.9% across all sectors in Q2. Multifamily was up 18.8%, retail up 18.5%, followed by commercial general at 17.1%, and office up 15.3%, industrial up 10.4%. So the only one that was below the average there. On a subsector basis, 12 of 15 posted double-digit annual growth. The biggest movers were bars and restaurants, up a staggering 42.2%, automotive up 36.6%, and storage up 27.3%. Hospitality here was the only laggard. Limited service hotels up 8.1%, full service hotels up just 4.9%. Now, we also broke out pricing data for the largest MSAs by population. To list those off, for those who may not remember, it's New York, Los Angeles, Chicago, Dallas, Houston, Washington, Philadelphia, Miami, Atlanta, and Phoenix. Across the four major property sectors, so industrial, office, multifamily, and retail. And these are median price per square foot values, so the swings can be big, but the direction and the range in each grouping do tell the story. By sector, industrial was the weakest. 7 of the 10 metros saw annual declines. This also was the widest spread of any sector. Phoenix saw prices down 37%, but Philly saw them up 54%. Office was the opposite. 7 of 10 metros posted gains. But there was also still a large spread. Atlanta up 46%, Houston down 31%. By market, Miami was one that stood out. Pricing across all four sectors was up, but on the opposite side, Houston and Los Angeles were actually down across the board, though LA was essentially flat as far as industrial pricing was concerned on an annual basis. And for a little bit of perspective on the extremes, the priciest market sector combo was Miami retail at $374 per square foot, while the least expensive was Houston industrial at just $57 per square foot. Now, digging a little bit into property sector trends, the typical single property deal profile did change pretty dramatically across sectors. Starting with multifamily, multifamily deals are getting quite a bit bigger. The median building size came in at about 9,000 square feet, slightly larger than last quarter, but the real story was in deal value, up nearly 20% from the first quarter and 25% from a year ago, hitting a median size of 1.7 million. Industrial is holding fairly steady. Median building size held around 15,100 square feet, and deal size climbed to about $1.7 million. That was up 7% quarterly and more than 12% annually. Office is showing surprising strength. Median building size jumped almost 7% from the last quarter to about 11,000 square feet, and deal size surged nearly 30% from a year ago, now up to 1.75 million. Retail is holding its ground. Typical buildings were about 9,100 square feet, essentially flat on the year, but deal values moved higher, up almost 14% quarter over quarter and 16% annually, reaching a median size of 1.45 million. And then there's hospitality, which is clearly the outlier by some of these metrics. Building size fell more than 9%, both quarterly and annually, and deal size slipped as well, down 4.5% from the first quarter and moderately lower than last year, landing at a median size of $3.9 million. So I've got some overall takeaways for you here. We're seeing big office and multifamily deals. Median values jumped nearly 30% for office and 25% for multifamily compared to a year ago. That pushed their sector level investment dollars much higher, even though fewer properties were trading. Industrial has cooled off quite a bit. Investment dollars in industrial fell 6.3% on the year. That's almost in line with the drop in property count, which is 6.7%. But industrial share of transactions continues to slip. It was 18.3% last year in quarter two 2024 and 16.3% in quarter two 2025. By contrast, multifamily surged to 31.9% of total dollars transacted in the second quarter, and that was up from the second quarter last year from 23.6%. Now, there is some major pricing divergence by sector. Industrial median price per square foot fell in 7 of the 10 largest markets, as mentioned, and manufacturing was the only subsector to show both quarterly and annual price declines. On a quarterly basis, this was down 3.3%, and on an annual basis, down 14.6%. Office, on the other hand, saw median prices climb in 7 of the 10 largest MSAs. I think this possibly hints at more certainty in service-related space than in goods-producing space. I'm just noting those manufacturing figures. There's a bit of a paradox when you look at the multifamily figures. Despite a surge in dollars and in deal size, pricing slipped in most of the top markets, in 6 of the top 10. But this, I think, implies that much of the momentum in multifamily, being up close to 40% annually in terms of dollars transacted, is actually coming from those mid-sized metros rather from the largest. But broadly, what we're seeing is the return of larger deals. It is not uniform across sectors, but we are seeing some bigger checks being written. The much-typed Liberation Day slowed down a bit, but it was a temporary blip in the beginning of the quarter rather than a lasting drag throughout. May have weighed more on industrial than any other sector, just noting some of those figures from before. I do think Q2 2025's numbers mark a clear shift in where investors are willing to commit long-term capital. I'm excited to see what happens in the second half of the year. Hopefully, it's a little bit quicker. Now, if you want to dig deeper, there's a lot more detail in the full report. I'll drop a link in the show notes where you can check out the interactive charts online or grab the full PDF. But before I wrap up, I'd like to tell you I appreciate it if you could rate the show. 5 stars on Apple or Spotify goes a long way. Feel free to leave us a comment as well. We will read them. And if you'd rather reach out directly, you can always email us at altusresearch@altusgroup.com. I'd love to hear what topics you'd covered on future episodes. Thanks for tuning in to the short episode. I'll catch you on the next time on CRE Exchange.